are actually things we're going to get done and finalized during this year. I'm in my 10th year on the board, and the room's starting to hit the backside, but in the 10 years, it took 10 years to get these things done. There was a result of the memorandum of understanding that we signed with the ISB shortly before I became a board member, and it's taken us 10 years to finish some of the more major items going forward. But each of these, one's done already, but in revision for implementation purposes revenue. But the other three leases and the financial instrument impairment and classification and measurement will be out this year before I leave on June 30th. Then what I want to do is talk to you about with 4 items where we're going on the path forward. And I was going to apologize for the 10-year sort of process, but then it was nice to have the Congressman talk about Congress not being able to get anything done, so at least we get things done in 10 years. So let's go on and talk about revenue recognition. For revenue recognition, it's a single principle-based revenue standard that when it issued in May of 2014 was virtually 99.9% converged. But in the transition process, some of the convergence is falling apart, and I'll describe that for you in a moment. This particular standard improves accounting for contracts with customers. At least that's what you would think it does exclusively, given the title of Topic 606, which is Contracts with Customers. But I will tell you, it's not limited to just that scope, and those who are beginning to implement or think about it or teach it ought to be aware of that, and I'll explain that more for you in a moment. It provides a more robust framework for recognizing revenue, increases comparability of revenue recognition across industries and capital markets, and for the users, what they like most is there's going to be better disclosure related to perhaps what's the most important line item in a financial statement. I'm going to give you a very high-level overview. 5 steps to apply the standard. The basic principle in the standard is to recognize revenue to depict the transfer of goods or services in an amount that reflects the consideration to which the entity expects to be entitled. We used to say that you recognize revenue when it's realized or realizable and earned. This is just another phraseology for the same thought process, because revenue is earned when you transfer the goods or services to the customer, and the amount to which you expect to be entitled is the amount that's realized or realizable. So it isn't a fundamental change in concept. It's just rewritten more from an asset liability view than a revenue expense view. 5 steps to be able to recognize revenue within the standard or the guidance. If you look for those 5 steps, you will not find them. But this is the way to think about it. You will not find them because of the way the codification is written. Some of these things have to be combined together in certain parts of the guidance. But the first thing is to identify the contract with the customer. So what is the contract that we're accounting for? Do we combine? Do we split? Is it really a substantive contract is the most important thing here. Because if it's not a substantive contract, revenue recognition is not going to be as suggested in steps 2 through 5. It'll be more delayed until cash is realized and other criteria are met. Second, once you have a contract with the customer, you have to identify what performance obligations are within that contract. Because seldom now do we ever have a contract where you deliver just one good or just one service. And the idea of identifying performance obligations is to find different items within the contract that are transferred to the customer at different points in time. Because if they're transferred at different points in time, we recognize revenue at different points in time, or either at a point in time or over time. So identify the performance obligations in the contract. The contract seldom is written, however, in step 3 to say the price for each of those performance obligations is X, Y, and Z. Typically it's written, here's the price for the contract. So step 3 is determine the full transaction price, right? And there's going to be a constraint on revenue there in that transaction price if some of the consideration is variable and therefore uncertain, to replace some of the conservatism that is in existing literature related to cash collectability and other items. So determine the transaction price and then allocate the transaction price to those separate performance obligations that will be recognized at different points in time or in different patterns over time, so that when you do satisfy that performance obligation by transferring the good or service to the customer, you recognize revenue at that time. That's the 5 steps. That sounds like that could be a really short standard. And the guidance with the basis of conclusions is about 900 pages. So there are lots and lots of details to make that very overarching thought process apply to the great variety of revenue transactions that exist in our business economy. And there are lots of implementation guidance that are there to let you understand better how certain of those more general principles will be applied in certain circumstances. And there is also a little secret here. There is certain guidance in this implementation guidance that's not even an application of the basic standard. It's an exception. And so you might want to see some of those. For example, the accounting for statutory warranties is an exception. Because in statutory warranties, what we say is debit expense when you recognize revenue and credit liability. Obviously, if you credit a liability, you cannot have satisfied that obligation. All right? And so there are some exceptions within the implementation guidance, and you should be ready to understand that there are exceptions. Here are the major changes that are in the standard. First, the standard focuses on a contract rather than transactions of certain types or by certain industries. So even within the same industry, there might be different revenue recognition depending upon the rights and obligations inherent in those contracts. And even if the revenue timing is not going to change as a result of this standard, the underlying implementation systems would have to change to be able to identify rights and obligations in contracts. There is a constraint in revenue that's introduced that says if you've got variable consideration, you can only include it in the transaction price, and if it's only included in the transaction price, if it meets this criterion, if it's outside it, it's not going to be recognized as revenue. And that constraint says only included if it's not probable that that amount could reverse over time. And not probable doesn't say it's 80 to 85%, it's basically you have to flip it. And if there's an uncertainty that it could reverse at, say probable is 75%. Don't take that as a bright line, but say it's 75 to 80%. That means if it's more than 20 to 25% of a reverse, it does not go in. Okay? That's how you would interpret not probable. There's brand new licenses guidance that we're still trying to tidy up to be able to apply. But here's some secret stuff that's in the standard that doesn't meet the title. Recognition and measurement guidance applies to transfers of sales of non-financial assets to non-customers. Remember, the title was revenue with contracts for customers. So old statement 66 on real estate, that old bag of rules that goes on forever is gone. And it's being replaced by the recognition and measurement guidance within topic 610 that refers to topic 606. Right? So there's some hidden guidance in there that you have to be aware of. In addition, there's guidance on costs in the standard. Cost to obtain and fulfill a contract with a customer. There's general guidance there that would apply if such costs are not addressed and be accounted for in other topics. And there are lots more disclosures. There's a transition resource group. Both boards thought it was bloody important that when we put out the standard that it be implemented as solidly as possible, so there's not a lot of restatements that occur or questions in the system when we go forward. So we put together, both boards jointly put together what's called the Transition Resource Group, which is experts across industries with different stakeholder backgrounds that solicit, analyze, and discuss issues people are having with implementing the standard. That discussion is not guidance, and it's not written up as guidance. It's input to the boards for us to consider whether or not we needed to change some of the standard to make it implementable out of the gate. But so there's been like 61 topics, that have come to the TRG, and a handful have gotten to standard setting. And so we have 3 exposure drafts out right now. But those other ones are discussed at the table, and if you are having trouble implementing the standard, you can go to our website under TRG and the minutes of the TRG, and you can read the discussion around the items we decided not to issue new standards for, or new guidance for, to get further insight into how to think about some of the more difficult issues. FASB has issued 3 proposed ASUs, the ISB issued 1 omnibus ASU, and the boards have diverged on how we've written and addressed some of those topics. Here's the topics in our 3 exposure drafts. And what you ought to know is anything that's italicized on this slide is stuff we wrote additional guidance about that the ISB has refused to write additional guidance about. So that's some insight into the differences and where some of these would suggest to you some of the more challenging areas in implementing the standard that you might want to be paying attention to carefully if you're in the process of implementation. Let's move to the leases, a joint project. The focus of the leasing standard, I've said over time, we started the leasing standard off of an SEC off-balance sheet report that said $1.25 trillion of lease obligations are off-balance sheet. It's the worst problem, get that liability on the balance sheet. And we raced to do that starting in 2006. The first meeting that we had on leases was in the first month I was on the board. But for at least 7 or 8 of the years, we never discussed, if you credit a liability, what is the asset? Pretty dumb and embarrassing to think about that. What is the nature of the asset that we're talking about? And I think the 2 boards still don't agree what the nature of the asset is, and you'll see that in a moment. But we've been saying all along, the nature of the asset is not the underlying. You do not get the underlying and own the asset typically in a lease. What is a lease contract conveys the right to use someone else's asset for a period of time in exchange for consideration. That makes perfect sense. But what does that mean about the economics of a leasing transaction? And the 2 boards disagree in that capacity. All leases are going to be capitalized on the balance sheet, except in U.S. GAAP, a slight exception. If the lease term is 12 months or less, you don't have to capitalize it on the balance sheet as a cost-benefit consideration. But other than that, all leases on the balance sheet, capitalized, asset equal liability on at inception. Under IFRS, that middle column, you used to hear me talk about type A and type B leases, right? Well, we finally got smart and said, isn't that stupid labels? Let's actually call them what we originally called them, finance and operating leases, because our lease model differentiates the accounting subsequently for those assets and liabilities in the income statement, depending on whether it's a capital or finance lease, as we think about it today under FAS 13, but written in the more general principle-based way in IAS 17 for leases. So the same sort of 4 criteria, but no bright lines. But we're going to say in the standard implementation guidance, if you apply that line using the 75 and 90% lines, those are not unreasonable ways to think about applying IAS 17. But it's also saying 89.9% isn't the get out of jail free card, okay, as you go forward. So the ISB views everything as finance leases. There is no distinction. We view in topic 842 there will be a distinction between finance and operating leases, not in the balance sheet at day 1, but subsequently. What do? So same line, same thought process. We view finance leases as constructive purchases of those assets. It's not, there's still right to use someone else's, but it's really a constructive purchase. It's as if you own. And so what happens in those settings is if you own, you actually experience not just the right to use, but you're going to experience unexpected diminution in value of that asset during the lease term, and you're going to use up that asset so much that there's not going to be much residual value left, so you're going to experience basically all of the economics of that leased item. And therefore, what you're paying for it, the lease liability, is not connected to the asset because you don't just get the right to use that asset, you get the right to use and all the other economics. So account for the asset separate from the liability, have separate amortization expense and interest expense, same cash flow treatment as we've always had. When we get to an operating lease, the economics that we will be arguing is all the economics you get is rights to equal access to that asset over time. You don't have those ownership benefits or gains or losses because you're going to give back an asset worth value. If the value of that asset decreased during the lease term in an unexpected pattern not built into the lease payments, it's the lessor's problem. And it's the residual value and how to handle the residual asset is the lessor's problem. So in that lease, what you do is all you do is pay for equal access to that asset over time. And if you pay equally for equal access to that asset over time, that liability and asset's value should be linked and of the same value. And if that asset and liability is of the same value, then you're going to end up having straight line expense as an outcome. And we're going to record it as a straight line rent expense or lease expense as the outcome with the typical treatment in the cash flow statements we've had with rent expense. Lessor accounting, both boards decided let's not fix what's not broken. And so basically we've not touched lessor accounting compared to the literature today. All we've done is change some language to make sure there's not inconsistencies on the way we talk about the same contract from the lessor and lessee, and also to make it less a risk and rewards conversation and more of a controllable conversation, because revenue recognition now is talking about recognizing revenue when you transfer control to someone else. But basically the accounting will not be changing. So if it's a constructive sale, you're getting rid of that asset, you take it off the books, and you recognize a net investment in the lease comprised of two components, the receivable you're going to get during the lease term and the residual asset, either presented separately on the face or in the footnotes in one line item on the face called net investment in leases. Because you constructively sold it, there's the possibility for profit on day one. Okay? But the possibility for profit's not going to change relative to direct financing and sales type leases that we have in the literature now, and interest income over time as you time value money accretes as the payments are being made. Same cash flow treatment. In terms of the operating leases, he did not constructively sell the asset. The lessor does not take it off its books, all right? And then what the lease income is all going to be over time, because there's no gain or loss to be recognized if you didn't de-recognize the original asset on day one. Let's move to financial instruments and concentrate on the area where we did most work, and that's with impairment. Here's some history behind the project. We formed a financial crisis advisory group of experts about impairment from many different stakeholders' perspectives around the world in 2008, in part because of strong political pressure to try to change things immediately. So to take some of the politics out of the setting, we went to some experts to give us advice as how to move forward, and that gave us some time to take a deep breath to figure out what we really could do, because in the banking and the credit crisis, it's absolutely clear that we did not have a strong indication as to which banks would fail and would not fail as a result of the credit crisis, and a general feeling in the economy that we got to a point that we were worried all of them could fail, and that basically shut down any ability to have loans in the crisis. And so we needed a better way to come up with understanding where the problems reside when there is strong credit or interest rate risk threatening the existence of banking going forward. The evaluation by this group said that we should explore alternatives to an incurred loss model. Very bad label. Because with an incurred loss model would really say don't recognize the losses until it's incurred. That would be until you don't get the cash. And we've never done that. The question's always been is the degree to which we build in expectations of losses earlier than when they're actually incurred. Okay? And the note was there's multiple impairment models, build one, and utilize more forward-looking information and estimate credit risk sooner than later. Some have been saying too little, too late. That's not a good phraseology, because you're going to come up with the same amount of loss no matter what you do. It's just going to be a different timing pattern. So it's when the timing of the losses are recognized that we're trying to fix. And the two boards came to different conclusions in part because of different starting points. The banks in the United States, even though we had a great deal of problems, had far greater reserves because of bank regulator pressure in applying the existing model to put pads to their reserves, had much greater reserves going into the crisis than, let's say, the European and other banks around the world. And so the model the ISB we came up with is to recognize all lifetime expected credit losses when you issue a loan. Under the notion, I put more loans out there, there's going to be greater expected credit losses the more loans I have. Lesser loans I have, lesser expected credit losses going forward. But the European banks could not actually deal with that without potentially threatening their existence. And so greater pressure on the ISB, who did not have bank regulators around the world padding the existing guidance, which was converged beforehand, went to a step model that you would recognize you have to predict in the next 12 months when you're going to have defaults, and pick up in those next 12 months the expected lifetime credit losses for defaults in the next 12 months, but ignore anything beyond the 12-month time period. That's step one. And then build up the full loss content if and when there's significant increase in credit risk in a particular instrument. So the huge difference, but the belief in Europe is their provisions or losses will go up by about 30-35%. If we had gone to that model, the allowance or our losses would have gone down, is what we understand. So what are we going to do in the current expected credit loss model? This is in comparison. This figure will show you how it steps up differently compared to our current. So at origination, you recognize full lifetime expected credit losses. Most people might think, because what we've been doing in our economy is 18 to 24 month general provision under Old Statement 5, when you issue a loan, that's how you can understand why it would dial back in the United States, because the ISB is only doing 12 months. But what some are worried about is you got to take the 12-month expected credit loss. If the expected duration of your loan is 7 years, you take the first year amount and multiply it by 7. That's not what we mean by full loss content. Because if you actually observe loss content within loans, what you see the loss curves look like this. Start out low, in the second or third year they get really high, and then they come down and tail off. And so the idea is to try to predict the full losses that you would see based on whatever loss curve is historically in place, updated for expected changes in conditions that exist today compared to what the average conditions are through history. And increase it if you're in a worse part of the cycle with lower underwriting standards, or decrease it if you're in a better part of the cycle with higher underwriting standards. That's the idea in getting up full loss content. So at origination, recognize lifetime expected credit losses, as I said today, at origination, 18 to 24 months of expected credit losses is typically the standard you see. There's no threshold for recognizing expected credit losses in the current model. You wait until it was lifetime expected credit losses. You wait until there was actually something you could observe related to a particular instrument before you jump to lifetime. Now that's the inherent problem in too late. To be able to actually attach to a particular instrument a problem, to go to Old Statement 114, accounting of full lifetime credit losses, it's often with a delay. You can attach economic problems to individual credits, and that makes it too late and pro-cyclical. Estimates updated each and every period, which is the same as today. Now, remember the Financial Crisis Advisory Group said one model, and we didn't end up with one model. Here are the two additional models that we have to the basic, what we call the CECL model, current expected credit loss model. The first one is for purchased assets that have experienced more than insignificant credit deterioration. If you're familiar with existing literature, that's not the same thing as the SOP 033 line, which was that it would have to be, you typically move from investment grade to non-investment grade. All it is more than insignificant credit deterioration. You got a lot of words on that slide. I'm not going to read them to you in that column, but the idea is as follows. If what I do is start off and I buy a purchased asset with more than insignificant credit deterioration, that discount rate, the effective rate in that asset is going to be much higher than the contractual rate because there's been more credit spread you need to put into it. There's a problem if what you do is record that at fair value and make it amortized cost, because the effective interest rate then reflected when you accrete from the fair value to the contractual cash flows would have built into it all the credit deterioration since initiation to the time you purchased, which would overinflate the interest income that you've had. So all we do in that particular model is say amortized cost isn't the fair value, it's fair value plus the allowance you have that day. That cleans up the interest income going forward to represent what the bank was willing to take on in credit risk on the day of purchase with the knowledge of that credit spread at that time. Users very definitely want that because through cycles, they want interest income separate from credit because as you go through the cycle, the amount that banks charge for loans they acquire or issue goes up as the credit problems go up. And there's insight in that interest income number for users to understand the risks throughout the cycle. Secondly, for AFS debt securities, we don't go to a full CECL model because in part to do that, you sort of need a portfolio of positions to do an expected credit loss history in the past. And often AFS debt securities do not fit into a portfolio. So what we do, and so you're estimating expected credit loss on individual instruments. So we develop and apply the CECL model in that respect to help entities do it on an individual instrument basis better by tweaking the current Topic 320 model and making it conform as best as possible with the current expected credit loss model. Let's go to classification and measurement. For a while, we were on a journey to try to get the same answers as the FASB. And we exposed a model that would change this significantly, to have classification be based on cash flow characteristics of an instrument and the business model as to how you want to realize value with an instrument. And we exposed that with the ISB. Major change in writing of how to think about classification and measurement. But as we deliberated it, we understood what they were doing in that process was trying to write a model and develop new guidance that would come to the same outcomes, generally speaking, as we already have in our own model. And the FASB there generally decided to step back and say, let's not make everybody change their systems and thought processes to generally have the same outcome as we have today. So we decided to keep our guidance and tweak it for the following ways. The only major change in classification is investments in equity securities will be measured at fair value net income, rather than some being able to be at fair value OCI. Under the notion you always have to sell those instruments and realize them, so the unrealized gain or loss will be realized at some time or another, put it in net income. That's not true, of course, for equity the equity securities that you account for under the equity method. That's still there. And we made a new accommodation that if you're investing in private equity securities, that's really difficult to be able to estimate what the fair value would be for a private equity security that you haven't observed exchanges on, and so what we ended up saying is, let's do fair value for those securities, but you don't have to remeasure to a new fair value unless you can observe a fair value for that security, either that particular security or another class of securities by that same issuer. Impairment still required there. We jumped in and said that fair value changes resulting from own credit for financial liabilities measured at fair value under the fair value option would be recognized in other comprehensive income. And we did some tidying up on some deferred tax asset issues, that there was some diversity in practice and refined disclosures related to fair values as a result of some further deliberations, but just minor tweaks in both of those areas. So not much change here. Reasons for retaining GAAP, I already explained that to you. The reasons for retaining GAAP is the outcomes weren't going to be different. And so we wanted to not shake up the system for this to get generally the same outcomes. So that's the major documents that you can expect. Revenue, there's ASUs out there, proposed ASUs out there right now, that we have every intent to try to finalize by the end of this year or early the beginning of next year, so that we can feel comfortable that you can implement with the delayed 1-year effective date that we already finalized, both boards finalized. Leases we expect to be done by the end of the year, maybe eke into the next year. My guess is that we're going to put classification and measurement and impairment out at the same time, and that we're already in the external review process for all those documents, which means we send them out to some experts in the area. They get commentary singularly about the operability of the wording and whether there's any confusion to try to clean that up. That those are all finished. It takes us a couple of months to be able to do the cleanup after that, and then we go into the balloting process where we end up picking effective dates. And you might want to know what are the effective dates. I could say, I don't know what they are. And we got a big struggle about that because we got some 3 big sets of changes out there going on now, right? And the big question is, should it be transition and death by about 3 major cuts? Or should we put them all together in a big bang and do it at once and therefore only have one system change? And we have very interesting conversations with our stakeholders about that trade-off, and we're going to have to figure that one out, so I can't tell you where it's going to be. It could all be in 18, or we could try to bleed it out later than 18. 18 is the effective date for public companies for the revenue standard. And I don't know what the answer is going to be. So now, let's look at some major things we're going to do going forward. One's the disclosure framework. And I think what you're going to get in your very last session of future trends in financial reporting is going to be a lot of discussion about disclosure. And I'm very happy to see that happen. Because what we're trying to do is reset the system. Yep, what we're trying to do in this disclosure framework and the 2 components process is to reset the system to end up trying to make disclosures more effective. Those of you who are preparers of financial statements, I didn't say reduce disclosure overload. Everyone out there wants to hear that when I've been saying for years, disclosure effectiveness. Disclosure effectiveness would mean we'd like to see some of the extraneous disclosures get out of the statements, but some of the other more important issues perhaps emphasized and a reevaluation within the system to have us maybe increase disclosures in some major areas that we don't have very good disclosures. One illustration would be inventory. If you are a company that has inventory, it's pretty darn important to your success. Yet if you go back to the old Committee on Accounting Procedure inventory disclosure requirements, they're basically absent. And so what we've got is tons of disclosure on taxes and fair values on manufacturing entities and little or nothing on inventory. That ought to be rebalanced to make this thing work better and for investors and other users to understand the economics of the entity better. So we're moving forward to do 2 things. We think that we have responsibility for some of the disclosure ineffectiveness that is rampant within the system now. Pages and pages and pages of disclosure that what happens every year is it's there already, let's move it into the next year, okay? And the users, and do it year after year after year, And what the users typically do is blackline the disclosures, and if one word changes, then they have to figure out what's the big deal about the change in the one word. That's how disclosures are being used. So we've got to figure out a way to write disclosures better. That's the board's decision process. But we also want to reset the system to encourage, as best as we can possible, to permit entities to more dynamically consider their disclosures so that they can become more effective. So there's two parts to that. We've already had a conceptual framework chapter on disclosures that has been issued, and comments were in and due last summer. We think that's working very well. The big part of that is a systematic framework for us to consider on a holistic basis the same issues for disclosure for every transaction, event, or circumstance that we set guidance for. Now, some will say, that really worries me, that means there's more disclosure. Each of those, that framework, we asked the board will ask, is it cost beneficial to require that disclosure for everyone, or at least for everyone to consider providing that disclosure? But we've finished that chapter, and instead of finalizing it, we're out there testing it by using it to reframe the disclosure proposals for fair value, for income taxes, for post-retirement benefit plans, inventory, and interim disclosures, to see how that would all work out and reset the system. And once we propose those and get them to come back, we will interact with the framework chapter with those disclosure requirements to see not only how should we finalize those, but what implications people's reactions to the proposed disclosures change will have for the framework itself. So instead of just saying the framework's good, road test it before finalizing. But more importantly, we think to reset the system, entities have to think about disclosures differently. And so we